Hey there, and welcome to this explainer. Look, if you've ever wanted to demystify the high-energy, incredibly fast-paced world of intraday trading, but just felt totally overwhelmed by all the charts, the numbers, and the crazy jargon, you are in the exact right place today. We're going to walk through a true practitioner's guide to intraday trading. We're building your understanding step by step, starting from absolute zero. My goal for us today? Total clarity on how to navigate this market safely and effectively.
Here is our roadmap for today. We're covering 1. The foundation of what intraday is. 2. Power-ups like leverage and margin. 3. Maneuvers, specifically going long and short. 4. Execution and order types. 5. The shield, looking at pros, cons, and risk. And finally, 6. A survival kit with beginner tips. Let's dive right in.
All right, Section 1, the foundation. What is intraday?
So, what exactly is intraday trading? Basically, it's the act of buying and selling an asset within the exact same day. Your one and only objective here is to capture quick momentum and secure a profit fast. The golden, unbreakable rule: you do not hold positions overnight. You open your trade, and before the day wraps up, you close it entirely. It's all about speed, short-term analysis, and just getting in and getting out cleanly.
Now, what's truly a game changer here is the massive shift in how and when we can actually trade. Traditionally, if you're looking at a standard stock market, like the Indian market for example, you are heavily restricted by time. The window opens up at 9:15 a.m. and it absolutely slams shut at 3:30 p.m. But modern platforms, things like Shark Exchange, which we're pulling our examples from today, completely flip the script. Suddenly, you've got 24/7, around-the-clock access to global US stocks and crypto. You can trade massive global assets like SpaceX or Google literally whenever you want. The candles on the chart never stop forming, which means the opportunities never stop either.
Moving on to Section 2, the power-ups, leverage and margin.
150x. I want you to just think about that number for a second. It brilliantly illustrates the shocking scaling power of leverage. In intraday trading, you don't actually need massive capital to make significant returns. On platforms like Shark Exchange, assets like Bitcoin offer up to 150 times leverage. But, let's bring it down to a simpler, more everyday example. If you use a 10x leverage and the market moves just a tiny 1% in your favor, well, that 1% move magically transforms into a 10% profit for you. It amplifies your buying power tremendously.
And that brings us directly to the connected concept of margin. Margin is essentially your skin in the game, the collateral you have to put down to actually use that leverage. Say you want to take a trade worth 1 lakh rupees, but you're utilizing 2x leverage. Well, your required margin, the actual cash tied up from your personal account, is only 50,000 rupees. So margin frees up your capital. It lets you punch way above your weight class and take much larger positions with far less upfront money.
Okay, Section 3, the maneuvers, going long and short. So a really crucial point to understand is that intraday trading is beautifully multi-directional. When you're going long, which is what most people are familiar with, you buy an asset first, you hope the price rises, and you profit from that increase. Simple, right? But going short is where intraday gets really fascinating. You can actually sell an asset first without even owning it. Seriously. For instance, if you analyze the chart and you are convinced the price of SpaceX is about to drop, you execute a short sell. When the price falls, you buy it back at that newer, cheaper price, and you pocket the difference as pure profit. So you can make money whether the market is climbing up to the moon or crashing down to the floor.
Let's look at Section 4, the execution.
Order types. When you finally decide to buy or sell, you basically have two main weapons at your disposal on the platform. The first is a market order. This one is built purely for speed. You hit the button, and boom, your trade executes immediately at whatever the best available price is right in that exact second. The second option is a limit order, and this one is all about precision. Let's say Google is currently trading around 360, but you only want to buy it if it dips to precisely 357. You set a limit order at 357. Your trade just waits there as an open order. It will only execute if and when the price hits your exact target. If it doesn't hit it, you simply don't enter the trade.
Next up, Section 5, the shield. We're going to cover pros, cons, and risk.
First off, let's quickly recap why this style of trading is so incredibly appealing to beginners in the first place. Number 1, you require much less capital because of margin. Number 2, you can profit from falling markets by shorting. Number 3, you get extremely quick returns because you aren't holding on to things for months or years. And wonderfully, you don't need to do any exhausting long-term fundamental analysis. You're just looking at short-term price action on much smaller timeframes, like 5-minute charts.
However,
We have to talk about the harsh reality of the practitioner's journey. Because you're using leverage, the risk is extremely high. Just as a 1% move can make you a 10% profit, a 1% move against you can instantly cause a massive 10% loss. This creates immense psychological stress. You're going to find yourself constantly staring at the screen. The market is totally unforgiving, and surviving it demands absolute, ironclad emotional discipline. You have to set your stop loss, which is the price where you automatically exit a losing trade, and you must never, ever move it just because you're hoping the market will magically turn around.
And this slide right here brilliantly illustrates the entire philosophy of risk management. Look, whenever you take a trade, only 4 things can possibly happen. 1, you make a big profit. Awesome. 2, you make a small profit. That is totally fine. 3, you take a small loss. Listen to me. That is perfectly normal and a guaranteed part of the game. But step 4, the big loss. Your entire career as an intraday trader relies entirely on completely eliminating that 4th step. If you keep your losses small by using a strict stop loss, you will live to trade another day.
Finally, Section 6, the Survival Kit, Beginner Tips. Before we get into the specific rules, I want you to consider this staggering number, 1.4 crore, or 14 million rupees. That is the actual amount of trading fees that Shark Exchange has refunded back to profitable traders as part of their 30-day challenge. It's an unbelievable incentive, basically giving you your fees back up to 10,000 rupees if you can just stay in the green. But to be one of the traders actually claiming that refund, you have to survive and you have to be profitable. So how do we systematically do that?
All right, here are your survival rules. First, you need to define a strict practice amount. This has to be money you're entirely willing to lose without losing a wink of sleep. Let's say it's 10,000 rupees. Next, you divide that up into small trades using a strict 1-to-2 risk-to-reward ratio. This is where the math actually starts working in your favor. If you risk 500 to make 1,000, you can literally be wrong on 10 out of 20 trades and still walk away with a net profit of 5,000 rupees. It's amazing. And finally, if you're brand new, leverage technology. Platforms often have a mirror app feature where you can automatically copy the exact trades of successful leaders. For instance, the KGF portfolio requires just a $5 recommended margin to start mirroring their successful trades right into your own account.
So, we've covered the foundation, the maneuvers, and the survival kit. But before you go and open up a chart and place your very first trade, I want to leave you with one critical, provocative question to think deeply about regarding the safety of your hard-earned account balance. What is the exact difference between isolated margin and cross margin? Does one protect your total balance while the other risks wiping it all out? Let me tell you, if you don't know the answer to this, your entire account could be at risk on a single bad trade. So do your research on this crucial distinction, implement the strict risk management we discussed today, and you are going to be well on your way. Thanks so much for joining me on this explainer, and keep learning.